All right, welcome back to Worldwide Exchange, everybody. I am Brian Sullivan, live in Frankfurt, Germany. Let's get back down to the developing story from this side of the Atlantic, and that is the good news that natural gas flows are resuming through the Nordstream 1 pipeline from Russia to Germany after being offline for 10 days. Let's talk about, though, what this means, given that we're only at 40% of capacity, and bring in Jeff Currie, Goldman Sachs Global Head of Commodities Research. Jeff, you guys nailed it. Your final research reports predicted 40% where we were pre-maintenance would come back online. I'm trying to call it good news, but how much does this resolve, if at all?
Yeah, I think your point. The fact that it's flowing is good news, but the bad news, we're only at 40%. Plus, there's caveats around that 40% that they could drop to 25% should there be any problems with, the upcoming turbine installation. I think the key point here is prices are likely to move substantially higher from here. Our target's 170 euros per megawatt hour. We're trading around, the 150 range right now, which means that's substantial upside. And I think the key point is that 40% is inadequate. You're still going to have to curtail significant industrial demand. It'll likely mean a contraction in places like Germany and Italy of 25% on industrial demand. That's significant. Which is why we'll have to ration prices, at much higher levels.
Yeah. And I want to make this point clear, and it's a little bit wonky, but I think it's WBI. We'll call it wonky but important, Jeff, which is this. Russian gas was about 55% of all German natural gas usage. Natural gas powers half of Germany's 43 million homes. This is not just about the Nord Stream, is it? There's 3 pipelines into Germany. The other 2 remain offline. So Nord Stream is just one of 3. It's the biggest. And it's only at 40%. So Germany as a whole is getting very low amounts of natural gas. You struggle to see how they're going to keep their industrial economy running and the lights on, especially if it's a colder winter.
Absolutely. The only saving grace right now is what's going on in China, because of the lockdowns around COVID and the weak activity in China. There's spare cargoes of LNG to make it into Europe that's easing the situation. We get a full-blown recovery in China in the second half of this year. That global LNG market tightens up and those BTUs become incredibly scarce. And as you go into the winter months, you're going to have to see rationing of demand, which is part of the reason why the EU came out with that emergency energy program that include demand rationing yesterday.
Yeah, and what is amazing about what the Germans have done well, and I'm going to give them some credit, Jeff, and other things that people here might argue that they screwed up, is that they were able to secure those 4 floating ships. The only 4 floating regasification ships available in the world, Germany was able to get so they could handle some imports of U.S. LNG. U.S. LNG prices have doubled from the United States to Europe, $16, I think, to 33. They're now above Asia. So, Jeff, in your analysis, which probably is good for Cheniere and Tellurian and some of these stocks, in your analysis, if Asia, if China were to come back fully online and European demand stays where it is, does the U.S. have the capability to add any more production, or are prices just going to go ballistic?
It's going to go ballistic. The ability for the U.S. to expand anytime in the near future is constrained by capacity, plus you have the outage with Freeport. Now, Freeport is expected to come back online. We expect it to be, somewhere around October, back up to around 1.2 BCF per day, and then back full stream towards January of next year. So that is one release valve, but beyond that, the system is capacity constrained. And by the way, everybody thinks, well, you're capacity constrained, Henry Hub can't respond to this. There's a lot of ways Henry Hub can respond to this, through coal exports, chemical exports, other manufacturing goods. So there's a lot of different ways that U.S. gas can creep out of the U.S. and into that global market.
Yeah, does what's happening here have an impact on U.S. gas and maybe U.S. oil, Jeff? I mean, if we get the reason that we're here is because Germany is not some tiny economy. I mean, it's the 4th biggest economy in the world. The collective European economy is about the same size as the United States. So the point I'm trying to tell while being here is that if we get a significant slowdown in industry in Germany or macro Europe, I mean, maybe this is better for the equity side of your team, Jeff, but what kind of knock-on impacts could that have on U.S. commodity markets or even U.S. equity markets?
Well, I want to begin by, when you look at the United States, it's a big exporter of pretty much every commodity that's in shortage right now. coal, gas, oil. It flirts with being, being adequately supplied. Throw in Canada, the whole region is long oil. It's long grains, agriculture product, chemicals, fertilizers, all of these things that the world is short. So the U.S. is well positioned to supply the world in this environment. That's part of the reason why the dollar is so strong, which is acting as a headwind for some of the other commodities. But absolutely, whether it's the commodities themselves or the equities. One last point, oil's off today because liquidity is so low. The equity risk premium, or what do you want to call it, in oil or the companies is extraordinarily large. In oil alone, it's 60% per annum, that front month, rolling the front month. The companies, their share prices are so low, they're at the troughs of the 08-09 recession. So there is extreme value. I want to emphasize extreme value in commodity equities, commodities, futures, all of it are substantially undervalued, particularly in the United States.
Yeah. Jeff Currie, really important conversation. The worst case scenario avoided, at least for today. The story not yet over, Jeff, though. We really appreciate your views and your thoughts. You nailed it with exactly the right prediction, Jeff. Congrats on that. Thank you. All right, I'm going to wrap it up here, Dom. I don't know how to say random but interesting in German, so I'm just going to go on. A couple of quick final thoughts. I'll tell you what, to Jeff's point, I know we got a lot of problems in America, but you look what's going on here. Inflation out of control, energy crisis, prime minister starting to drop like flies. And oh, by the way, sovereign debt concerns growing in Italy, Greece, and other nations. Kind of feels like 2009 with an energy crisis laid on top. We're pretty lucky to be in the United States. Maybe it's net bullish, Dom, for the United States. They're paying $47 to $50 per unit of natural gas. We're paying $7. I want people to understand that, and their electricity prices are probably going to triple heading into the winter. Europe is in a tough spot, and this is not a small economy. And if China comes back online, it could get even worse. But I want to do the positives. The pipeline came back online. That's the good news. I want to leave it at that. Back to you, Dom.
All right, we are balanced about it. Brian.